Okay, we're going to get started again with the first of our academic paper presentation sessions. This one on innovations in measurement and theory. Let me hand it over to Luigi Zingales from University of Chicago Booth to chair things and get things started.
Okay, I'm very happy to take over. If you can share also my video, because apparently it has been stopped by Central. Okay, I can start my video, fantastic. So there are two very interesting papers about innovations in measurement and theory. The first one is by Lin Shen and co-author about on ESG investing, heterogeneous preferences, information and asset pricing. Lin, the floor is yours.
Thank you, Luigi. Let me first share my screen. Can you see my screen?
Yes, very well. Yeah.
Great, thank you. All right. Thanks, Luigi, for the introduction, and thanks for including our paper in this excellent conference. This is a joint work with Itai Gostian, Alexander Kopytov, and Haotian Shan. I believe all three of them are in the panel with us, so they can help with the questions in the chat box. Okay. So as a motivation, undoubtedly, we see a rapid growth in ESG appetites among investors and the amount of ESG investments in recent years. For example, this table from 2020 Global Sustainable Investment Review shows that ESG investment as of the dollar amount and also market share plays a very important role in the asset management industry recently, and it's still growing in most of the parts of the world. And related to that, there are also papers to look at what are the driving forces for this trend in ESG investment. And for example, this paper by Rideau and Smith, they show that investors do have heterogeneous social preferences, and it is their intrinsic social preferences rather than the financial motives that are playing a dominant role in determining their socially responsible investment strategies. And in light of this growth in ESG appetites and ESG investment, what we're doing in this paper is to build a theory about how asset prices are formed when investors potentially value assets for different reasons. For example, some care more about the ESG performance, while others care more about the cash flows generated by these assets. Okay? And in more particularly, we look at we build a model within the noisy REE framework following Helwig 1980 paper. Well, what's not standard and what's novel in our paper is that we allow two different payoff components for the risky asset, monetary and non-monetary component, or cash flow and ESG components. And we have two types of rational investors, traditional and green. By their names, traditional investors care more about the monetary return, while green investors care more about the non-monetary payoff. And importantly, because they value the assets for different reasons, they trade differently, even though they receive the same information. Okay, and this model can help shed light on three important questions related to ESG investments. So firstly, how do these different types of investors, traditional and green investors, interact on asset markets? And second, what type of information is incorporated in the price? If we see a high stock price, does that mean the firm has good ESG performance or good cash flow performance? And thirdly, our model can help shed light on some of the implications of recent ESG related trends. And in terms of the results, the first important result coming out of this model is that there might be multiple equilibria with distinct pricing functions. So in particular, we may have a T equilibrium where traditional investors are the dominating group. They trade very aggressively to align the price with their preference. And because the price is aligned with their preference, price is very informative about the monetary payoff of the stock and very informative to traditional investors. So they face less informational risk when they trade, and that justifies why they trade very aggressively at the first place. So there is a feedback loop going on to support this traditional equilibrium, T equilibrium. And correspondingly, we have another equilibrium, which is J equilibrium, where green investors are the dominating group, and the price is mostly associated with the ESG performance of the stocks. And after characterizing the equilibria, we then look at the implications of an increasing number of green investors. And interestingly, and very naturally, in fact, the price will become less informative about the monetary payoff because it will become more aligned with ESG investors' preference. And therefore, it becomes noisier to traditional investors. And as a result, traditional investors may require higher return for bearing such informational risk, and cost of capital for the firm may increase. And second implication is motivated by the recent trend of this regulatory push for better ESG-related information disclosure. So if we have more or better quality of ESG information, then it will directly benefit all investors. However, because green investors directly care about ESG performance, they will benefit more. If they benefit more than traditional investors, they will trade more aggressively and align the price with their preference. And as a result, this indirect effect may make the price become noisier to traditional investors, and cost of capital may increase. So this is a theory paper, and here comes the model. In this model, we have a financial markets where two types of assets are traded, a risk-free asset and a risky stock. The risk-free asset serves as a numeraire, so the payoff and price both normalize to 1. And the risky stock will have a unit supply, and as I mentioned, it has two payoff components, monetary and non-monetary, Z and delta. And the price of this risky stock will be endogenously determined by the market clearing condition. So both components follow a normal distribution. And we have two types of rational investors, traditional and green. They will trade based on their private signals, and they will also learn from the price. And in this presentation, I will focus on a simplified model where each group will have equal mass 0.5 of the total mass M, and this will be relaxed in the main model. And in addition to rational investors, we also have noisy traders where they don't trade based on the fundamental informations. Their trade is simply exogenously given, and it follows a normal distribution. And let's zoom in for the preference of these rational investors. Basically, they have a standard CAR utility function. However, the payoff that they receive from holding one share of the stock may be different. So specifically, the payoff is a weighted average of these two components, Z and delta. And the first important feature of the model is that investors care differently about different components. There is preference heterogeneity. And in the simplified model, we simply assume polar preference in the sense that traditional investors only care about the monetary payoff, and green investors only care about the non-monetary component. And this assumption will be relaxed in the main model. And the second important feature is about the information structure. So although each rational investor only care about one component, they receive two private signals about the two components. And for example, traditional investors, they only care about cash flows, but they can also learn about ESG prospects of the firm from news, from disclosure statements, so on and so forth. And this is very important. And later on, we will relax this symmetric information structure to look at the implications of better ESG information. Okay. So this is the rational investors' belief. And now we can characterize their trading behavior. Because of this standard CAR normal setup, their demand is simply their expected payoff from holding the stock minus the price of the stock divided by the risk aversion and the amount of residual risk given all the information that they have, including their private signals and the information they can learn from the price. And then we can aggregate individual demand within types and then across types plus the amount of noise demand to get the total demand. And we have the supply of 1, and this is the market current condition. We focus on the equilibrium with linear prices in the sense that the equilibrium price will be a linear function of both payoff components and also the noise demand. And the key equilibrium objects that we're focusing on are these two normalized price coefficients, CZ and C delta, about monetary and non-monetary components. So basically, they tell us what is the amount of monetary and non-monetary information that's incorporated in the price. And it turns out that these two equilibrium objects, CZ and C delta, are characterized by rational investors' trading intensity. So let's take traditional investors as an example. So their trading intensity is defined as the sensitivity of their demand with respect to the information that they have. So from traditional investors' point of view, they care about the monetary return Z, and this information about Z is their perceived fundamental information. And when they see better fundamental information about good cash flow information, for example, they will demand more of the stock. So their trading intensity is positive and it's constant. This is a standard result, just like in Howick 1980 paper. However, what's novel in our paper is that there is actually another trading intensity. So when the traditional investors see better ESG information, from their perspective, that's kind of like a mispricing. If they see good ESG information, they know that the price is likely to be inflated by the good ESG performance of the firm, and they don't want to overpay for that. So they will reduce their demand so that the trading intensity is actually negative. And it's going to be proportional to the price informativeness. If the price is very informative, then they face less risk when they trade, and they will trade more aggressively. And as I mentioned, these trading intensities of different groups are basically going to shape the information content of price. And in equilibrium, these two price coefficients are nothing but the aggregate trading intensity of all investors of both groups about different payoff components. And interestingly, these two types of investors, they will trade in opposite directions. So for example, the information about cash flow from traditional investors' point of view, that's fundamental information, they're going to trade for it. While the same information to green investors are the perceived mispricing information, and they're going to trade against it. And importantly, their trading intensity with respect to their mispricing information is proportional to the ratio of price informativeness. And this will give us a very important and interesting feedback loop between price informativeness and trading intensity. So basically, if the price is not informative about ESG, but very informative about cash flow, then the price is very noisy to green investors and informative to traditional investors. As a result, traditional investors will trade very aggressively because they face lower informational risk when they trade. If they trade very aggressively against green information, against ESG information, that will reduce the price association with ESG information. So this is a very large negative number that will reduce the price association with ESG information. And this will complete this feedback loop. And this feedback loop may give rise to multiple equilibria. If there is a lot of noise, exogenous noise, this noise trades, then essentially the price is not informative to either group, and their informed trading will not change the information content of the price by a lot, and we will have a unique equilibrium. But when the exogenous noise is small, then this feedback loop will prevail, and there might be multiple equilibria. So in a T equilibrium, the traditional investors will trade aggressively. The price will be very informative about the monetary component, not informative about the non-monetary component, and it's the price is informative to traditional investors. While in a G equilibrium, it's the opposite. Green investors trade aggressively. Price is informative about ESG information, and it's very informative to green investors. And similarly, in the main model, where we relax this polar preference assumption by allowing the green investors to care about both components, and we relax this equal mass assumption by allowing different fractions of traditional and green investors, we can still have multiple equilibria. And next, I'm going to talk about these two experiments that we do, and we look at what are the implications of some recent ESG trends. And the first one is about this increase in alpha. what will happen if we have a larger fraction of green investors in the investor base. So naturally, in terms of the aggregate trading, the green investors becomes more influential. They will align the price with their preference that will reduce the price association with cash flow information and increase the price association with ESG information. And that will naturally make price noisier to traditional investors and more informative to green investors. And more interestingly is the implications on the cost of capital. So cost of capital is defined as the expectation of the monetary payoff minus the price. So this reflects the amount of money that the firm needs to give up in exchange for capital at price Q. And this cost of capital basically reflects the weighted average informational risk. And it turns out that if we increase the fraction of green investors in this economy, there is this non-monotone relationship. So the cost of capital will first go up and then go down. And specifically in this region, where most of the investors are traditional investors, if we add more and more green investors into this economy, then the price becomes noisier to most of the investors, and the weighted average informational risk will go up. Investors on average require higher return as compensation, cost of capital may go up. And this can help reconcile some of the mixed evidence on green premium versus green discount. Okay. And the second implication that we look at is what will happen if we have better ESG related information. And to do that, we first relax this information structure by allowing different precisions about monetary and non-monetary information. And naturally, as I mentioned, if we have better information that benefits everyone, however, it benefits green investors more, and they will align the price with their preference. And it may happen that the price will become less informative about the cash flows, and price will become less informative to traditional investors. And this can undermine regulators' intention to help investors make informed investment decisions. So essentially, from traditional investors' point of view, better ESG information dilutes the information contained in the price about cash flows, and that's essentially adding noise to the price and making price noisier. And as a result, they may require higher return and cost of capital may go up. So just to conclude, we have a standard RE model, however, with heterogeneous preferences, and this may give rise to multiple equilibria. And we also look at some of the implications of recent trend. If we increase the fraction of green investors in the investor base, that may reduce the price informativeness to traditional investors and increase cost of capital. And even we have better ESG information, this may backfire because that may reduce the price informativeness to traditional investors and raise the cost of capital for the firm. Okay, I'll stop here. That's all. Thank you very much.
Thank you very much. The next paper is by Roberto Rigobon and is very appropriate, the ESG confusion and stock returns, tackling the problem of noise. Roberto, the floor is yours.
Thank you so much. Thank you, Luigi, so much. Let me share my slides. I hope you can see it. Okay. This is a paper with Florian Berg, Julian Cowell, and Anna Pavlova, and let me tell you more or less what we're trying to do in this paper. So we want to know first if ESG is good or bad for stock returns. And so the question would be, if I had to run a regression on stock returns on the left, and I put a rating score on the right-hand side, what is the sign of B? What would be the type of biases that B will have? Now, the limitation of answering this question comes from the fact that the ratings that we measure are incredibly noisy. So this is from an aggregate confusion paper, and what I'm showing to the right, I'm not pretending that you can read the name of the companies. You probably know the names of all the companies that are here, but what we did was to put 100 firms, 150 firms on the right, the 150 firms on the left. The ones on the right have a lot of consistency. This is the ranking among a common pool of almost 1,000 firms, and what is their place in the ranking. And you have 5 different rating agencies, and the ranking on the right actually looks very similar to credit ratings scores of at personal level. The FICO scores will have discrepancies, but they are relatively small. So the guys on the right, they are very tight. You have firms that are good and everybody agrees they are good. You have firms that are bad, everybody agrees that are bad. But a lot of the data looks like the panel on the left, which is confetti graph. It looks like there's a line in the middle, but that's because we organized the data by the median. So we sorted the data by the median, but truly, if you were just to put the average, this will look exactly the same and it's all over the place. And there are many firms that will be in the bottom 5% for one rating agency and in the top 10% for another rating agency. One of them, for example, is Sony. So if you don't want to have Sony in your portfolio, well, you choose one rating agency in which it justifies that they are super dirty and super bad. But if you want to have Sony in your portfolio, then you pick another one that gives you in the top 10%. So when you have so much noise in the data, the question is how we do the estimation. Furthermore, why is this noise taking place? So a lot of what we found in our paper is that a lot of the noise comes, more than 50% comes from the measurement. So they are trying to measure the same thing, the same attribute, electromagnetic field pollution and CO2 emissions, and those are actually measured very badly. So 50% of this discrepancy comes not from different views about what sustainability is, it comes from the measurement problem. So what we find in this paper is that actually what we're going to do is to use an instrumental variable approach. The noise in the indicators implies that all the OLS coefficients are biased downward. We correct that, and we have an increase of about almost double, a little bit. So there's an increase in almost all the coefficients that we estimate when we do the instrumentation. Furthermore, because of the procedure that we use, we can infer what is the implied noise in each of the rating agencies. And in fact, that tends to align quite well with the type of data that they use. Okay, so that's it's kind of reassuring. So let me just explain in simple terms, this is, what we're doing. On the Y will be kind of the stock returns or the profits or what is the variable that we're interested. The Z will be the true attribute that about ESG. So assume that we are going to do this very narrowly. We don't do it that way, but just as an example, assume that the Z are the CO2 emissions of the company. We truly don't observe the actual CO2 emissions. We observe an estimate of that. So we observe X, and that's the estimate. And we want to know what is the impact or what should be the beta. So when we run the regression, we actually run the regression of the stock returns, Y, on the noisy measure, BX. And under certain assumptions, we can actually find exactly how B looks like under the classical assumptions of errors in variables. And the classical assumption means that the error, the eta, the noise is uncorrelated with the Z, the variable that you're observing, and it's also uncorrelated with the epsilon, the variable that is moving the stock return. So the error is truly an error. It's, it's not related to the measurement itself, and it's not related to the firm itself. And in fact, I will come back to that because this is something we have many instruments, so we can test. So, but when you use the classical assumptions, we know that what is going to happen is that depending on the noise, the bias will diminish the effect that you observe. And the intuition of that is very simple. When the X moves because the Z move, then the relationship between X and Y will be determined by beta. But when the X moves because of noise, so it's just garbage, then there will be no stock returns. So truly the OLS coefficient is a combination of the two. It's a combination of the beta, but it's also a combination of zeros that are coming from the noise. In fact, if you take the noise to infinity, what is going to happen is that the B that you will observe is 0. If the noise is 0, then you will actually observe the true beta. So it's what is called an attenuation bias, because the negatives will become more positive and the positive will become more negative. Okay, now there's a way to solve that, which is to have another variable that also measures Z, also imperfectly, that is not part of our analysis. We're going to use as an instrument. And again, there are very important assumptions here about the orthogonality between the errors. So imagine that the first stock is MSCI, the first rating agency, the X is MSCI, and the second rating agency, W, is Sustainalytics. Well, it happens to be that if the errors of Sustainalytics and the errors of MSCI are uncorrelated with each other, we can use Sustainalytics as an instrument for X. And this is the instrumental variable at the bottom. This is the instrumental variable estimator, and you recover the true beta. Now, there are many assumptions here that are important, and therefore we have to be careful with these assumptions, okay? Let me be more precise what we estimate. We're gonna estimate expected stock returns on the left-hand side. We're gonna put the Y is what it will be the true ESG performance, and we're gonna do this at the all aggregate level, so E, S, and G all together. But we use a lot of controls, and these are the standard controls that you will use in an asset pricing model. So we have, book to market value, market capitalization, momentum, etc. So we have a lot of controls. Now, because we don't observe the Y, we're going to actually only observe the S. The question is, well, we are expecting the B to be smaller than that C impact that we're calling. That would be the true impact for 1 metric ton of CO2 emissions, or an improvement in the ESG performance. It could be labor practice standards. We will have a bias. And now we have 8 rating agencies. So that's the nice part, is that we have many rating agencies that all of them are trying to measure the same thing. This is the most simple way. In fact, you can extend this to say that the rating agencies have a constant plus a slope multiplied by Y. All of that will go through. It is actually no difference whatsoever. But we have many rating agencies, and all of them are making different type of mistakes, and presumably they are all trying to measure the ESG score. Now, the classical assumptions implies that the errors that they are making have to be orthogonal, which is the first assumption there on the classical errors. There are other assumptions that are important, but this one is kind of very important, because it's assuming that the errors that MSCI makes are uncorrelated with the errors that Sustainalytics makes. And it's conceivable that they don't. Maybe they are based on the same data source, and therefore they have even similar procedures, econometric procedures, so they will be making similar mistakes. Now, the beauty of having many instruments is that we can test over-identifying restriction test, and we can test whether or not these assumptions make sense. And furthermore, we are going to define a procedure in which we're going to try to eliminate the instrument that is the one that that is causing the rejection. In that sense, the nice thing is that not only we have a set of assumptions that we're looking at that is classical, so we're thinking about, well, non-linearities, for example, will produce a non-classical errors invariable, which means that the epsilon and the Y will be correlated. When you have a rating agencies that are observing what each other are doing, well, that will violate the first of those expectations in the last line. And when you have, for example, rating agencies that are kind of trying to track the stock returns, so imagine that I want to give good ratings for the ones that are performing better, well, that will violate the third one. And so we have ways to understand when the violations take place. We don't know which one. When we find a violation, we don't know which one is being violated. That's a weakness. We have to think a little bit harder about how to do that. But when we run the instruments and we don't reject the identifying restrictions test, then we know that some of these assumptions will be accepted. So the rating agencies that we use are RepRisk, True Value Labs, MSCI, Sustainalytics, ISS, Asset4, and SP and Global. They use very different data sources, and that's very nice. So some of them use corporate social responsibility reports. Another one uses regulatory filings that tend to be mandatory. This is EPA, for example, when you have an accident. A lot of them use the media. Well, actually, 2 of them are very heavy on the media, True Value and RepRisk. So therefore, they are daily. The other ones tend to change at most once a year. Many of them use questionnaires, but not all of them. So they actually talk to management to try to understand what their intentions are on the particular dimensions. And they use, some of them use other data sources, private third-party data sources that have done estimations outside the normal data. So they purchase data from other data providers. So they have very different data sets. So we expect them to have different sources of noise. And in some sense, that's kind of, it gives us hope that we will be able to find a proper instrument. So we're going to run a regression, stock returns on the left-hand side. We're going to estimate first the OLS with all the controls. Then we will instrument instrumental variable, implementing a 2-stage least square. So we will run a first stage, which is the instrument or the rating agency we're interested. So we're interested in MSCI, and we're going to run that on many of the rating agencies B. Now, When we do that, we will get an estimate of that rating agency, and then we run the second regression, and that will give us the estimate of the two-stage least square. In our procedure, what has to happen is that the residuals of the second regression should be orthogonal to the instrument itself. That's the over-identifying restriction test. So when you have more than one instrument, you can actually test that. And if you reject, we have 7, we start with the maximum, we start with 7, and if that rejects, then we start with 6, and so on. So we have like a pruning procedure, and then what we're trying to do is to find which set of instruments do not reject the over-identifying restrictions test. In fact, we have 2 procedures in the paper. I'm going to show results only for one. They are very consistent with each other. So these are the results we estimate for every one of the rating agencies. So when we're using MSCI, we're using the others as instruments and so on. We estimate in 3 different regions, and part of this is because there are different levels of development in terms of the markets, how mature they are. Looking at the numbers is hard. I just want to point out to some things, like for example, true values go from 0.13. These are basis points. So 0.13 is 13 basis points, goes to 70. VGO goes from 4 to 41. S&P goes from 1 to 20. I hope you can see that they are kind of increasing, most of them. MSCI from 20 to 28. Sustainalytics from 10 to 52. So when you actually look at the change in the coefficients, they almost all of them tend to be positive. There are some of them that are negative. So we have massive attenuation bias in our data. So in 24 possible estimates, we have attenuation bias in 20 of them. We actually test the significance of this doing a Hausman test. In a Hausman test, the instrumental variable is unbiased, but is inefficient. The OLS on the null hypothesis of no errors in variables, the OLS is efficient. So we can test if these two are statistically different from each other, and we actually did that test in the Hausman test. And we have many of these rejections. Many of these differences are statistically different from 0. Let me show you a little bit about the instruments in this procedure that we're pruning. In this procedure of pruning, it happens to be that, for example, in Europe, everybody's a good instrument of everybody, okay? But in the US, you can see that MSCI was always a bad instrument, a very, very bad instrument. So one possible explanation, I mean, we don't have an idea, but one possible explanation is that MSCI is a big leader in the United States, and rating agencies are observing what MSCI is doing. Therefore, the mistakes of MSCI, the errors of MSCI propagate into the other rating agencies. One really nice thing about here that just to highlight is that true values and rep risk, both of those are based on heavily on media outlets. So rep risk is purely about media. So they are trying to detect if in the newspapers, if you have bad news, they are mostly thinking about bad things that happen to the firms. True values has a combination of media plus public data. But on the month-to-month, the variation is coming all from media. And I expect those noises to be uncorrelated with the typical noise that you will have in Standard & Poor's, for example, MSCI, ISS, Sustainalytics, because those companies that I just mentioned, they tend to do surveys and talk to management. So the type of noise that you will have are very, very different. So this was kind of reassuring. And we also, I mean, we don't understand exactly, we don't know, when I said also, is that we don't know exactly why we're getting the rejections in the US and nothing in Europe, but I mean, this is what we're getting, okay? So, and again, over-identifying restrictions test has a size, and therefore, it could be explained by the size, some of this. Finally, and let me finish with that, so I do my 15 minutes, is that by comparing the two-stage least square to the OLS, we have an estimate of the noise. And this formula here, I'm just doing the simplistic because I show you the assumptions that we have. But if you assume that each of the rating agencies still is a biased version of the Y, this goes through perfectly. What you require here is to have the classical assumptions. If that's the case, we can measure what is implicit noise in each of the rating agencies. And again, true value labs are super noisy. And again, we expected that. RepRisk is also very noisy. And you have the MSCI, Sustainalytics, ISS, S&P are less noisy. VGO is less noisy. So we kind of expected this. Now, one important thing is that even though you have true values that is very noisy, that means that maybe true values is a bad regressor, but it's a great instrument. So it's not clear that you should not purchase true values. So by the way, this is not It's not like this section is sponsored by True Value Labs, but I'm just making a statement that the fact that something is noisy doesn't necessarily mean that it's useless. So True Value Labs might be very noisy, but it's a really, really good instrument in our data. So truly, it corrects the mistakes of the others. So I think that there's a lot of work to be done in ESG rating agencies. That we need to think deeper at the level of the category, and part of this noise that we want to correct is happening at the level of the actual attributes that we're measuring. We did not run this at the attribute level, but clearly this is something that we can do, and we can think about this moving forward. But this is a procedure that will help us understand what are the implicit noises and what are the returns. At the end of the day, we're finding that the returns are twice as large than what we have estimated before. The interpretation of the coefficients doesn't necessarily get fixed, in the sense that we get positive coefficients, and this could be that there's the ESG is correlated with management quality, with other things that we are not instrumenting. Truly, we're mostly and only instrumenting by the noise. So there are other aspects that we should correct to be able to have a much better picture. Let me just stop there. So my 15 minutes are over. Thank you so much for the invitation to everybody.
So thank you very much, Roberto. Now the discussant is Jonathan Parker.
Oops. Again, can you start my video? Host, I got dinged earlier because I can't start it myself. There we go, good. Thank you very much. Great. Okay, it's a pleasure to be here. Thank you very much, and to be discussing these two papers. So what I'm going to try and do is place these papers a little bit into the broader context in which they sit, as well as just giving you some sense as to what they're doing and what they're up to. I'll start with summarizing first the one that's sort of the theoretical paper, which asks the question, in a market with noise, so that we don't completely understand how the fundamental is reflected in price, that we don't learn everything from the price of the asset. When there are two types of investors, one that cares primarily about the fundamental cash flow payoff of the asset, and one that cares fundamentally about the greenness or the green performance of the firm, which is separate. And there's a version of the model where these two things are completely, the two clienteles are completely separate, and a version where they're correlated. We can talk as if they're completely separate, I think, because the model implications are the same. In a world where you can't learn everything from price, where these two types of investors, there's two types of idiosyncratic private signals that they get about the greenness or the fundamental cash flow of the given asset that we're trading. They try and infer from the asset price what that is, and then they decide how aggressively to take a long or a short position. And we're going to see what that implies for the equilibrium returns and performance of green firms and non-green firms. And then the second paper asks a measurement question about the same issue, which is that we have rating agencies that are giving evaluations of the different firms and saying this one is a green or a non-green firm. And I'll use that as a shortcut for all ESG issues for the purpose of this discussion. How much does that alter returns? And so I want to give you the basic overview of each paper, starting with the theoretical one. And then I want to give you the sort of some discussion of the points. What do we take from these papers? So first of all, the very nice theoretical paper. There are two types of investors, green and traditional, and there's actually noise traders also, which means that we can't learn everything from prices. The T, or traditional investors, care more about the cash flows, and the green investors care more about the green payout. And they both get these individual private signals of both the cash flow and the green payout. So both the green investors and the traditional investors are paying attention to both of these signals. So it's not that you don't see what the green investors see if you're a cash flow investor and a traditional investor, and the reverse. And then the payoffs that they care about, the green investors care about the payoff and the green payout, and the traditional investors care about the cash flow payout. They both trade, they both see the equilibrium price and can adjust their trades so that there's an equilibrium here. And then there are payoffs. And that's kind of interesting, or I think one of the ways to think about this world is from the perspective of a traditional investor, the green investors are also noise investors. about whom they get a signal. So that when there's more green investors, it's like there's also, from their perspective, more noise investors. And then it's symmetric, so that from the green perspective, when there are more traditional investors, there are more noise investors. And so that increases the noisiness of the stock from the perspective of the green investors. Right? So that says then that when there are green investors, they add volatility to the stock price that are based on the signals about the greenness of the corporation that they get. And that means that from the traditional investor's perspective, that stock is now noisier. There's more uncertainty when they move to invest in it. And so they're going to rely less on, they're going to be less aggressive. That's a stock that they know less about. Whereas, and then when they're less aggressive, the green investors now have less noise from their perspective because the traditional investors are pulling back and being less, are having less price impact. They're trading less on what they think they know. And that means that the noise that the green investors perceive in the payout goes down, in the price, excuse me, goes down. And so that the green investors invest slightly more aggressively. And so there's this really nice multiplicity, or not multiplicity, complementarity in strategies. When more green investors enter, traditional investors see more noise, they scale back their trading and therefore their price impact, which scales back the noise that they provide from the perspective of the green investor, and the green investor then trades more aggressively. And that can actually lead to these multiple equilibria regions where you can get a bunch of green investors crowding out the traditional investors, or the reverse, and just kind of the either equilibrium could occur. So that's kind of that's really kind of the interesting and central insight of the paper, which is that in a market, adding a bunch of investors who care about green outcomes or ESG in general, who trade on idiosyncratic, their own private information to some extent about that green strategy, leads to more noise from the perspective of the traditional investor and can crowd them out more potentially than the green people come in. There's several implications and thoughts that this paper discusses some of, and I'm going to discuss some of also. First of all, the cost of capital for the firm. So what we this model is not a model in which the cash flows are influenced by investment behavior, but one can take from the model, because it's a nicely done model of capital markets, what that implies for the corporate finance decision making. And so the cost of capital for a firm is highest when the noise is the highest, which is when there's a balance between the traditional and the green investors. Okay, so that means in some sense, you might think, where are we now in the world? Well, we're in the world where green investors are a growing share, but still sort of small. As they grow more, the traditional investors are going to find that somewhat frustrating because the noise in the stock is going to go up, so they're going to step back. The green investors aren't going to have lots of decreasing, they're not going to put a lot of green information into the stock price, so they're still going to perceive the stock price as somewhat as noisy, as not giving them much information about the information of others. And so the cost of capital to firms may go up. And if you think about where the green firms are now, they still don't probably have a majority of green investors. And so you might think that in some sense right now we're in a world where ESG targeting firms that are being invested in by the green funds are actually slightly increasing potentially the cost of capital. That's a warning that comes out of this paper, this model. The second interesting thing is that there might be a natural segregation of clienteles for different stocks. The investors that desire green stocks or high ESG scores and the investors that value only cash flows may naturally segregate into trading different stocks due to this complementarity, right? So the green investors, if they all flow into one stock and the traditional investors leave, that's beautiful for the green investors. They now have no traditional investors providing additional variation in the price that might move it away from the fundamentals they care about based on information that they don't care about payoffs that they don't care about. Similarly, the traditional investors are happier when there are no green investors around, or more aggressive in their trading because the green investors add noise that makes it hard for them to interpret what they learn from the price of the stock. So that's a very nice thing. And that might lead into different segregated clienteles for different stocks, that some companies will pitch themselves very much towards green investors, and other companies will pitch themselves entirely away from green investors. And that can avoid that first bullet point. That can avoid the high cost of capital and potentially lead the two sets of firms both to have low cost of capital. Which stocks? So which stocks do you pick is to some extent an arbitrary in the model, a little bit arbitrary in the place where there could be multiple equilibria, where either green or traditional investors dominate trading in a given stock. But if you think about now variation in the fundamentals of the stocks, the green investors ought to be concentrating in stocks where there's lots of green information arriving. And the traditional investors should be focusing on stocks where there's a lot of cash flow information arriving. And so that might mean that the right thing for green investors to be doing, given their green goals, is to be investing in stocks where there's a lot of where the stock price is very informative to them and pushing them into it. So that might mean that they will invest in ExxonMobil, where the change in green payout might be the largest potentially, and where there's a lot of information about that payout. So it might have slightly some perverse, the channel focused on in this paper about green investors liking stocks where there is not a lot of traditional cash flow information arriving and where there's a lot of green payout information arriving, might lead to slightly perverse allocation by the green investors relative to what we're used to thinking about. I encourage the authors to build that out a little bit more. I think that's quite interesting. Finally, on this paper, the last thing I want to talk about is the corporate incentives. If you think about the firm's interest in maximizing share price, they care a lot about the clientele that's holding their stock. And so in this world where one firm is traded mostly by green investors, then its two payouts that it has, that it's delivering, cash flow and green value, it ought to care much more about green value, because an increase in green value now will lead to a much bigger payout to its shareholders and a much bigger increase in valuation, because that's what they really care about. And so the clientele, the division of clientele suggested by this paper is really important for thinking about what then the incentives are the firm to take actions to vary cash flow, not just about cost of capital here, but strategic decisions about which projects to pursue and how to pursue them. Right? And I think that's more important than the cost of capital channel. And that also will be reflected in something I'll come back to, and something the chair of this session has worked a lot on, is governance issues, not just, and the previous panel talked about, not just the cost of capital, price of investment, but green issues. The second paper I want to talk about is the one Roberto just presented, which was about ESG confusion and stock returns, tackling the problem of noise. And so there's two parts to the paper. The first is a model with green and traditional investors and public noisy signals about ESG that are uncorrelated with the cash flow. And the main insight of this model, which is sort of reasonably intuitive, is that when there's a specific green demand for an ESG stock, that absorbs some of the risk of that stock and raises its price, which is kind of, you can think of as being set by the traditional investor, or the traditional investors are at least a significant part of setting the return. Green demand raises the ESG stock price, it lowers the return of the price, and both effects tend to be bigger with more precise signals. So then the empirical question is, well, what does a high-rated ESG firm's return look like? Is it indeed lower than a poorly rated ESG firm? And the interesting finding, the strategy is, okay, we don't have good measurement of ESG. Roberto went over this nicely. We're going to use one measure as our regressor, and then we're going to instrument it with the other regressors to correct for the fact that that first one is mismeasured. And what you find is the striking find is sort of the opposite of the theory, that better ESG ratings lowers stock prices and raises returns. And so what do we want to make of this? It's kind of crazy. So one might think at first, well, okay, maybe ESG doesn't lower the cost of capital. That is, a bunch of new green investors flow into a stock. They lower the cost of capital for that firm. That firm then gets to do great things and has a higher rate of return. And the fact that it's lower capital raises its rate of return. Well, that sort of doesn't make sense once you think about it. It can't be that you lower the cost of capital for a firm by pushing down the return, and that leads to have a higher return. No, it either has a lower or a higher return. It can't be both. And so what that leads one to conclude from these results is that it's actually an unexpected factor that has raised ESG returns ex post. So this paper is studying ex post returns, which are not expected returns. And it turns out that this was a good time that they're looking at for ESG factors. Firms that loaded onto ESG factors happen to have really good returns during the period they're looking at. And so that, to me, leads to a slightly different way of framing the regression analysis that they're doing. I would think that they want to use time t+1 controls. In other words, if you're looking at the return during time t+1, you want to control for it with the factors that stock normally loads onto in addition to the GSG regressors, not just predetermined controls. You could have things like size and value and various asset pricing factors in there. And then the second question, the final point on this specific paper I want to talk about is, what is it that the ESG ratings measure? So Roberto talked about the fact that you can reject the over-identifying restrictions, which means that there is no linear combination of the other ESG ratings, which provides a sufficient statistic for predicting returns that can't be improved on by a second linear combination of those other ratings. So there's more information than can be captured by one, and not just linear. I mean, it's linear in all the instruments you consider, but you can consider interactions and various other squares of, and so on and so forth. But whatever, it doesn't collapse down to one variable. Okay. And so you might think that's just because there's a bunch of different ESG factors out there that ESG measurements tend to load on. Example would be governance versus carbon emissions, or different ways that different firms are even affected by different carbon emissions. So there can be a carbon producer that is hurt by, say, the news that a green technology is becoming cheaper. I mean, I'm assuming here's someone who's selling the carbon gas, for example. If solar becomes much cheaper, that's bad news for that firm. A firm that's producing a lot of carbon, that might be good news for it, because it could eventually become cheap enough that it's actually a lowering costs for that firm of production. Right, so different ex post shocks lead to different returns to different ESG dimensions. And that then again makes me think about, what is the factor structure in the cross section that this paper is really identifying off? Which firms are loading on which ESG factors and the news about them that's arriving? Because this is, I think, a paper entirely about measuring differences in the shocks that have hit the economy and the way that the firms have loaded on those shocks in an unexpected way that's related to ESG, rather than this is differences in expected returns and differences in cost of capital. So I think it is absolutely not a paper about differences in cost of capital. It's differences in exposure to the shocks that have hit the economy during the time period that they're studying. Let me conclude with just a few thoughts about ESG more generally, and what that these papers make us think about. The papers focus on the impact of ESG ratings and ESG investors on stock returns and asset market returns. And then each of them takes from their analysis what are some of the implications for the cost of capital. But I think that's not really the big channel here. And I want to emphasize instead the governance channel, or the voting shareholder channel, or the projects that the firm actually goes and chooses whether to be ESG or whether not to be ESG, whether they're maximizing the payoff to the G or the payoff to the cash flow, and what balance they put on that. And that is controlled by voting, by shareholder governance, by clientele effects, if you were owned only by green investors, for example. And I want to flag that as owners, ESG funds are historically pretty active anti-ESG. We have Geeta Rao here. I think she's running the next session. She's also been working a lot on this. She taught me that the Vanguard Social Index Fund has voted against almost all environmental resolutions. despite being a social index fund. It picks stocks that are green, and then it doesn't do anything to make them greener. As Luigi has shown me in theory, it's much better for an environmental fund, or it will have more impact if it picks stocks that are not green and tries to make them green. Okay. So the exception to this already mentioned is, of course, engine number one. It got mutual funds to vote for an ESG board member for ExxonMobil, but the case it made was entirely one of raising returns. So it was acting as a fundamental investor, not a green investor, and trying to convince people that as a fundamental investor, green was the way to go, which is quite different than the messages or the theoretical environment analyzed by both of these papers. Okay. So the last point, I think it's worth maybe some discussion or thinking through going forward, is what are the legalisms here? What's the legalistics look like? Is it legal for a mutual fund to announce and then vote for ESG proposals when it means lower stock returns? I mean, the announce is key because it's clearly illegal if they don't announce it. But could they say, we're not going to maximize, we're a mutual fund, we're not going to maximize return, even though that's the legal charge of a mutual fund, we're going to maximize ESG impact. Is it legal to do that in retirement accounts where they have a fiduciary duty now to the investor? Obviously, that fiduciary duty has been interpreted in the narrowly in the past as about returns, but could it be about broader social objectives if, again, the investor, me at the end point, chooses to put my money into a social choice fund rather than an index fund? And then finally, there's a question as whether, oops, I kind of in the way here, but whether we can change corporate governance or so that investors can change the goals of the corporation, so that the board and the CEO no longer have the fiduciary duty to maximize returns for the shareholder, but hold other duties in their goal set. Clearly, that's different in Europe than it is here, but it does raise some issues that we might all be happy with green, but we might be less happy with some of the other goals that might then get incorporated on boards by shareholders' proposals and the like. Okay, I think my time's up. Thank you very much. I'll turn it back to you, Luigi.
Thank you very much, Jonathan, for an excellent discussion and also for a plug. I think that actually investors can change the statute of their company. There is a statute now called Benefit Corporation, and if a majority of shareholders vote to transform the corporation into a benefit corporation, they can consider legally other things in their in the objective function. Now, the question is whether the investors can do that, and that's a separate question, a very interesting one. Let me ask, your discussion and the positioning or the juxtaposition of the two papers raises a number of interesting questions, and one I would like to ask Lynn is the following. Why do you need noise traders when, as Jonathan said, you have endogenously the other side of traders? Once you have traders with two objectives, one is the noise traders for the other, because if I only care in the extreme form, if I only care about the green component, I'm a noise trader for the cash flow and vice versa. And so maybe you can get rid of the noise trader and just have the two categories, and maybe the results are the same or different. The other question, which is related, is your results, at least as I understand them, they are all about the aggregate cost of capital because you have just one firm. And it's not obvious that once you introduce multiple firms with a different loading on green and cash flow, that the results are the same, or even that the cross-section, the increase in cost of capital, depending on how many investors there are, go in the same direction. Have you thought about that?
Thanks for the question, Luigi. And yes, so first of all, regarding getting rid of the noise traders, we haven't done that, but I think what as the noise traders itself, then it's possible to get rid of the noise trader for good. And we can try that out. And a second, so this is actually also related to Jonathan's discussion about the segregation of quantiles. So it did.
Lynn, you're breaking up a lot, so you might turn off your camera and try keeping talking. Otherwise, we'll have to move on to other questions.
Investors to invest in multiple firms, and then we may see the segregation of clienteles where green investors, they predominantly trade green firms. Sorry.
Okay. So I said you're breaking up a lot. You might turn off your camera.
Oh, I see. Hello, can you hear me now?
Yes, very well.
Oh,
yeah.
I should do that earlier. But basically, the second question is about what happens if we have more firms. And one natural outcome is actually related to what Jonathan pointed out, that there will be a segregation of quantiles where the green investors tend to trade with, so different groups, they tend to trade more with their peers. So green stocks tend to be held mostly by green investors, and brown firms tend to be held mostly by traditional investors, and both will suffer less from this mixed investor base increasing cost of capital effect. However, if we want to go in that direction, I think necessarily we need to add other motives, because investors, for example, for diversification benefit, they want to include more stocks into their portfolios, or in other words, this segregation will not be fully segregated. If we look at different firms, naturally there will be a mixture of both green and brown firms. So there still will be such effect coming from this mixed investor base. However,
okay, given that we cannot hear you very well, let me ask you a very quick question to Roberto, and then we'll finish the session. Roberto, what is your view? Because between this view of expected return or unexpected events, you ran a regression with some stuff that is known. So why is that not in the information set of investors? And what is your interpretation of your results in terms of, is this an indication that we are in a disequilibrium phenomenon, has been unexpected events, or is it a risk factor?
Yeah, thanks, and thanks, Jonathan, for the discussion. Indeed, we noticed that we were getting positive coefficients when our model predicted negative ones. Our interpretation is that this is due to a lot of unexpected flows into ESG. So it's kind of the transition. It's a little bit what Jonathan is saying, that maybe this is about ex post returns, not expected returns. And the ex post is happening because there's a massive inflow that is taking place toward ESG flows, and that aggregate shock is difficult to separate. So again, we can only instrument for the noise, but not for this aggregate shock about that. So truly, I think it's mostly a transition. If I have to pick a choice. Now, there's no total agreement among us. If you ask about to Florian about this, he will respond that this is related to aspects like management quality, that it happens to be that is correlated with ESG. So as management quality somehow is improving, then they also are better at ESG. So they treat their workers nicely, and they're also better at management. And that would be kind of an omitted variable bias that we will have in our regression. So that could explain the positive coefficients. Is one of the reasons why we separated this is because we thought that European markets, because they are more mature, that we will be more likely to find coefficients to be negative, but we were wrong. So we get positive almost everywhere, except for one regression. We get positive everywhere. So this was very surprising. We knew that by when we corrected the errors, this is gonna make the puzzle even harder because we will get much higher coefficients. But yes, so that part of what is left unsaid in our paper is about why this is positive. We tried doing this contemporaneous, Jonathan. So we tried everything on T, and we got practically the same coefficient. So maybe your suggestion about using the controls on T plus 1, we have implicitly run them. So, but we got virtually the same results. And there are many robustness that, you know, we have not reported. Book value, market value. So we have actually put many different regressors and controls, and we just get a positive coefficient. It's just very, very surprising. So,
but Roberto, if that's the case, that what drives is the inflow, then the rating that is more important is the more influential one, not necessarily the most right one or the most correct one. So maybe you can rank ratings depending on how massively used they are or how influential they are, and see whether they have a different impact on the returns.
Yeah, so in that sense, in the US, for example, we have some information about flow, so we could somehow respond to that. But I kind of know that in the US, MSCI is the dominant one, and not surprisingly, they are as a regressor, they will be the best one for the US. So that goes to your intuition, Luigi. That would be correct.
Can I highlight that, Luigi? That's a really important point, if I have a minute.
Please.
Since the returns are unexpected returns that you're picking up here, then it is not necessarily the case that what is a good ESG rating has anything to do with a good predictor of what returns would be in the future, or what companies would even be most green. It has just happened to be correlated with ex post the shocks that hit the economy and cause changes in returns.
Yeah, I mean, I don't think that we ever say good or bad. We only say good instrument.
Yeah, you don't. No, I agree. It's purely about interpretation.
Exactly. So we can qualify who's good as an instrument. That's for sure. So we know who is a bad instrument, but we never say this is a good ESG rater. But you're right. But in responding to that, it is the case that MSCI was had a much tighter estimate for the US. It was the one that was really close. No.
So I'm going to break in and just say it's fine to keep on talking, but everyone who needs to take a break should take a 10-minute break, because that's the time we have, and we'll start the next session in 10 minutes. But I don't want to stop this conversation. So go ahead.